All right, guys. So we are now moving on to the tools of the Federal Reserve. And if you remember the last lecture, we talked about two things that the Fed is looking to do as it looks out over the economy. And it determines perhaps if things need to loosen up a little bit, right? If the economy is stagnant, if the economy looks too tight in their estimation, and things are not looking, oh, what the heck? The things are not looking like they should. In other words, business is slow, people are not buying, GDP is not growing, housing starts are down, investment is down, right? All of this means a stagnancy or slowness to the economy that we don't want. And so if we see that in the economy, right, then our goal is to loosen. Wish I had a different kind of pen that was neater than this, but we'll see if we can get one. All right, but our goal is to, this looks like a threatening note, okay? Our goal is to loosen the money supply. How do you loosen the money supply? By dropping money from the Fed down into the banking system. And we'll talk a little bit about how in the tools section, right? Moving on right now, we're talking about what happens in the opposite situation. What happens if the economy seems like it is heating up a little bit too much, right? You want a hot economy, but what you don't want is an economy that equals a general rise in prices, or what we call inflation, right? That's an upward arrow. So if inflation's going up, prices are going up, and there's an overall, we're not talking about a successful business raising the prices on a product. That's not inflation. We're talking about overall rise in prices in the economy. There's too much money out there, and prices and wages are rising, and we're starting to see this inflationary situation. Then we do not want to loosen the money supply, but we want to tighten the money supply, right? That's what we would need to do in that circumstance. And as the Fed, when they want to tighten the money supply, they're going to vacuum up that excess cash that's in the banks, and it's causing the banks to have a very loose loan policy. And so now we want to tighten up that loan policy if the economy is inflating or seems like it's headed in that direction. So we're going to watch GDP, we're going to watch inflation, and as the Fed, we're going to make decisions on how to do this. So now you might be asking, okay, I get the loosen tighten part, I get what the Fed is concerned about, I get that they need to deal with it, but how do we regulate this? Well, the Fed does this by using its tools. Now, you're going to see in different places different tools of the Fed. You might see people talking about 4 tools of the Fed, 3 tools of the Fed. I'm going to do 5 tools of the Fed because there's a tool that you might not see listed, but it's one that's used very, very often. And so we're going to call it one of the tools. So imagine that the Fed has a toolbox and that they can use various means. Now, over time, since the Fed was created in 1913, these tools have changed. So a long time ago, there was a tool called selective credit controls, and the Fed usually really stopped using that tool. Actually, it's been since about 2008, 2009, which sounds a long time ago, but is really not a long time ago in the life of the Federal Reserve. You're going to see that the Fed has adopted some new tools, and we're going to talk about one in particular at the end, and one that's kind of a new tool still coming online. Now, you have to remember that with the Fed, things are in flux, and now more than ever. But we're going to talk about the 2008 recession and the new tools that started getting relied on. First, we're going to go into a little bit more of the traditional tools of the Fed. They're very important for you to understand, and especially as the Fed is using one of them more than the others now, it's a good contrast, okay? So you are responsible to know the tools of the Fed as I explain them now. All right, are you ready? Okay, let's do the first tool. It has the advantage of being the easiest to understand. All right, here we go. Okay, our number one tool of the Fed is called dealing with reserve requirements. So the first tool of the Fed is simply that, remember that 10% reserve that we talked about the other day, that as that bank statement, that bank liability sheet, assets and liability sheet, T sheet, people brought money into the bank. The Fed requires them, their oversight institution, requires them to take a percentage of the total deposit and keep it in reserves. Now, the bank has that as a minimum reserve. Let's say that the reserve requirement is 10%. Every deposit made in the bank has to have 10% reserve requirement if that's the reserve requirement set by the Fed. Now, banks, if they wanted to, they could have a 40% reserve. They could have a 90% reserve. But why would banks not do that? Well, that has to do with the answer on the bottom of the quiz that you took early in the week, right? That banks don't want to hold all their money in reserves because what they want to do is loan the money out and make interest on the money. And so generally banks want to loan. The reserves are there to keep banks from being irresponsible, to keep banks from overloaning, to keep banks from having a run where they don't have the money to give to a person making a demand deposit with a demand deposit request, making a withdrawal of cash. So the reserve requirements, generally, that's what banks tend to keep. They tend to keep what the Fed asks them to keep. So imagine then that a bank, typical bank has a 10% reserve requirement. Now, let's just imagine that the bank has $1 million in deposits, all right? And that means that they have $100,000 in reserves, right? 10% of $1 million. So they've got $100,000 in reserves. Now, if the Fed looks out at the economy and they say, you know what, we've got to loosen this up, right? We've got to send some more money into the economy. Well, they can simply lower the reserve requirement. Let's say they lower the reserve requirement to 5%. And that means that $50,000 out of that 100,000, you understand we're going to go from 10 to 5. $50,000 now can just slide right over into what? Into loanable funds. Does that make sense? Because they only are required to hold on to 5%, which means that $50,000 is now free to be loaned out into loanable funds. So imagine what a bank's actual assets would be and what their actual reserve requirement is, that actual money that they have to hold on to. If you cut that reserve requirement by a percentage point or a half percentage point, it pulls all that money into an available loanable fund side, and that loosens up the money supply. Same thing on the opposite side. Let's say that the Fed's looking out in the economy and they say this thing is too loose. There's too many loans being made and we're seeing an inflation problem, or we're thinking that the economy's headed toward inflation. Well, they can simply raise the reserve requirement. And so let's say if a bank has $100,000, right, in reserves, and now imagine that the Fed says, well, we're gonna double that. Now the reserve requirements are 20%. Well, can you imagine where will the bank get that? They'll have to pull another $100,000 out of the loanable funds equation. That means, whoa, we can't lend nearly as much. I can't believe the Fed just did this to us. They raised the reserve requirement to 20%, pull $100,000 out of our loanable funds. Well, that's $100,000 that we no longer have to work with. It's off the table. We can't loan it. Do you understand how it's tightened up? And when it tightens up, guess what the bank's going to do? They're going to say, well, now that we have far less loanable funds, we're going to pull the interest up on the loanable funds we do have because we've got less to loan. We still want to make the same amount of money. And so we're going to charge our customers. Well, that's getting done exactly what the Fed wants. It's getting done that tightening up of the money supply. And they're saying to the banks, hey, you're being too loose. Not only will the banks that are controlled by the Fed follow, but other banks will follow as well. And so when you see this lowering or raising of the reserve requirement, you understand that it can both loosen and tighten the money supply, right? Everybody got that? Now, let's just say something about reserve requirements. Very seldom used. And the reason why is because reserve requirements, they cannot act without really shocking the economy. I mean, to just make this across the board rise or lowering to the reserve requirement, it has a shock effect. And that's not really what the Fed wants to do. It wants to maneuver, it wants to nuance. It doesn't usually want to make shock waves that it's sending through an economy because that can kick off nervousness, it can kick out skittish feelings about expectations. There's a lot of psychology to the actions of the Fed. We're going to talk about that in a couple more tools. And so reserve requirements, they're very simple to understand. I hope you understand them, but they're not a tool that's often used because they have such a dramatic impact. You raise or lower that reserve requirement, it's happening with all those banks, and it's happening today because now it becomes law. And it does not just affect new loans, it affects all loans, right? That's why it has that immediate powerful effect. So reserve requirements are a good and understandable tool of the Fed, but not very frequently used. All right, that's tool one. Let's move on to the next tool, which is tool two, open market operations. I would say that this is the most difficult to understand tool that the Fed has. So what you see here in the picture is a group of economists discussing and working on the open market of the sale of bonds and treasury bills, okay? So remember in the Khan Academy video, it talked about T-bills or treasury bills kind of being like an IOU that people owe the bank. When the bank gives someone money and they agree to pay it back, it's an IOU, okay? The government also has IOUs that they can deal with. They can borrow money from the banks by writing IOUs, or they can sell money to the banks. And so this is done through what's called a treasury bill. It's a promise to pay later for money that you're getting or putting off now. Let me try to illustrate this with an actual example. Now in class, I have plenty of space to do this and plenty of people to work with, and I actually pass out some, fake paper, but since we can't do that, I'm gonna try to see if we can get it done another way. So hang tight.